That'll less likely be an issue for a while because there's not that much demand for Bitcoin denominated loans.
Yeah.
And historically where there have been, it's for leveraging. It's for, you're borrowing Bitcoin, then you're buying Grayscale, for example. That's kind of an old trade of the past. There's not a lot of like commercial uses of a Bitcoin loan, while it has this kind of big price variance. So I think it's less about that and more just about, exchange hacks or custody hacks and things like that. For example, I don't really expect Fidelity or BlackRock necessarily to fractionally reserve it or rehypothecate it.
Don't forget to subscribe, traders. Let's continue with the interview to analyze it later and also comment on some of the most important news of the day.
Because it's such an easy mistake for them to get caught out on it. But it's possible. So for me, I think the bigger risk is probably state confiscation. That if everything kind of gets pulled into big, large buckets, they can say, look, these things are no longer withdrawable. And you can make up reason X, Y, Z. You can say it's
6102 in our Bitcoin.
Yeah, or at least saying, it's walled garden Bitcoin, and we can't let it into the wild because of terrorist financing or whatever the reason they can do. That I would consider probably the bigger risk, because I'm less concerned around how Fidelity manages their Bitcoin or BlackRock. I'm more concerned with what they might be told to do with it one day.
Because they want to steal it? Because their own economy's screwed? Their own currency's screwed?
It could be that reason. It could also be, over time, the financial systems become more and more surveilled, more and more controlled, and they don't really like free-range Bitcoin too much. It's harder for them to
free-range
Bitcoin. So they could eventually clamp down on that, especially if there's some major negative event and people get very emotionally driven. Imagine if 9/11 was obviously a very, tragic event, but then they were able to get the Patriot Act through fairly easily. And they're able to drum up, people's desire to go to war with a country that wasn't even involved in the attacks, Iraq. Imagine if there's some sort of similar major event, and they say, look, we have to clamp down on Bitcoin. We can't let terrorist financing happen with it, or we can't let X, Y, Z, or, we have to have more control over this. And you can get kind of an excuse to block the exits. Even just financial repression. Like, for example, when Argentina is having a currency crisis and they pass things saying banks can't, offer it to their customers, or even fintech companies can't offer it. And they never say it's because we're having a currency crisis. They say, look, it's, money laundering and AML, and we have to maintain bank stability. They'll say any number of kind of normal sounding jargon for why they can't do it, when really it's because they want to slow down the currency crisis. You see that with Nigeria, you see that with Turkey. And the way they're often phrase it is either something like that, like we want to do safety and stability, or they'll blame, quote, speculators. The people are speculating with the currency. And so they'll try to block the exits there and kind of demonize a certain group. So I do have concerns around, in many jurisdictions, eventually a sovereign entity kind of taking over those big Bitcoin honeypots.
State confiscation of large Bitcoin holdings presents a complex and multifaceted risk landscape, particularly concerning the potential repercussions of state intervention. This intervention can be initiated through legislative actions, regulatory frameworks, or direct seizure of assets. The very nature of Bitcoin, which is decentralized and often perceived as a means to circumvent traditional financial systems, places it in the crosshairs of governmental scrutiny and potential action. One of the primary risks of state intervention is the erosion of trust in the cryptocurrency market. Bitcoin and other cryptocurrencies thrive on the principle of decentralization, offering users an alternative to government-controlled currencies and financial systems. When a state intervenes, it can signal to the market that cryptocurrencies are not immune to traditional forms of control and regulation, which could undermine their fundamental appeal. This erosion of trust can lead to a decrease in Bitcoin's value, as investors may perceive it as a less stable or secure asset. Furthermore, state confiscation can disrupt the anonymity and privacy that Bitcoin users value. Governments might implement stringent Know Your Customer (KYC) and anti-money laundering (AML) regulations, requiring detailed information about Bitcoin holders. Such measures could deter users who prioritize privacy and lead to a decline in Bitcoin adoption and usage. The fear of losing anonymity could also push users towards alternative cryptocurrencies or financial instruments that promise better privacy protection. The economic implications of state intervention are significant. Confiscating large Bitcoin holdings can lead to market volatility. If a government decides to liquidate these holdings, it could flood the market, causing a sharp decline in Bitcoin prices. This market instability can have broader economic consequences, affecting not just individual investors, but also companies and institutions that have integrated Bitcoin into their financial strategies.
Yeah, I think there are interesting price signals from that. But I think also part of the issue is people underestimate the risk that they take on. And so with DeFi, it's less risky for the borrower, but it's very risky for the lender, because in addition to liquidation risk, you have hack risk.
Yeah.
And that's something that often gets kind of overlooked, I think. So it's not necessarily priced accurately. But I would expect probably over time for the Bitcoin collateralized lending rates to go down, because if you look at mostly how they work, like the ones that do it properly, like Unchained, for example, there's no rehypothecation. Yeah. Those have very low loss rates. I mean, 0 in many cases, because you're fully collateralized by the Bitcoin. It's a liquid market. Technically, the only way that you could really, as a lender, lose money is if Bitcoin has a very illiquid loss in price. So it basically it would lose value so quickly that you can't even sell the collateral and recoup the loan. So outside of that very specific scenario, it's a mostly risk-free lending. You'd expect the rates to probably go down eventually, but it's not a market that I follow super closely.
Decentralized finance, DeFi, offers a unique landscape in the financial sector, bringing both opportunities and risks. For borrowers, DeFi presents a lower risk profile compared to traditional finance, largely because they can leverage assets such as cryptocurrencies without needing to meet the stringent credit requirements typical of conventional lending institutions. This flexibility and accessibility attract many users to DeFi platforms. However, for lenders, DeFi carries a higher risk, primarily due to the potential for liquidation and security vulnerabilities. The decentralized nature of these platforms means they often operate without the same regulatory oversight and safeguards as traditional financial institutions. This can lead to significant risks being overlooked, such as the possibility of smart contract hacks, which have historically resulted in substantial financial losses. These risks make lending in the DeFi space a more precarious endeavor, requiring lenders to be highly vigilant and informed about the platforms they use. Despite these challenges, there are promising trends within DeFi, particularly regarding collateralized lending. When using Bitcoin as collateral, the rates for such loans are expected to decrease over time. This is attributed to the low loss rates when these transactions are executed properly. As the mechanisms and security protocols of DeFi platforms continue to evolve and improve, the reliability and attractiveness of using Bitcoin as collateral are likely to enhance, potentially making DeFi a more stable and appealing option for both borrowers and lenders in the long term. In summary, while DeFi presents a landscape of both lower and higher risks for borrowers and lenders respectively, ongoing developments and improvements in the ecosystem, particularly in collateralized lending, are paving the way for a more secure and efficient financial future.